Good afternoon. Welcome to the TheoTrade evening video. I'm Blake Young, and today is May 25th, 2023. Today, we're going to ask, will the Fed ignore critical data? Taking a look to start with U.S. equities, we can see that equities have been very resilient. We're holding up pretty strong in the same price action we've been at now all the way since the very last trading day of March. Very, very flat. Prices are stuck. And we're near annual highs, at least based off of the S&P futures. Watching that, yes, the S&P futures are a lot weaker, I guess, or not running as fast and as far as the Nasdaq, being lifted by NVIDIA. But what we're looking at is this situation is we're going to ignore NVIDIA and we're going to focus on what's happening with bonds and the economy. So equities are flat, perfectly flat in this growth. Now, the question that I ask is, why did we have the growth through here? What was the catalyst that pushed this? And if we were to look directly at what I think is the culprit, I would say it is bond yields. So if we take a look at the 10-year Treasury, 10-year Treasury yields went from 4% all the way down to 3.2%. That 0.8% move is significant when we're talking about borrowing billions and trillions of dollars, whether we're talking about consumers or businesses or, most importantly, the government. So that drop in cost of yield stimulates the economy. Low interest rates, what created the growth in the economy in the first place. The ZIRP, zero interest rate policy, where you could borrow at 2% and 3%. That is what created so much strength and growth in the economy. Well, yields dropped by that 0.8%, money became cheap, and this is a direct correlation to when equities started to climb. Now that we're starting to climb, we've broken out the sideways move in Treasury yield and started pushing higher. At the same time, bond prices are falling. Now, why are bond prices falling? Well, the first thing is they're falling because there's no demand. There's limited demand. We might be pricing in some of the future expectations of the new treasuries that are going to be issued. If we take a look at the Treasury notes, and this is the same thing for the ZB or the ZN, we're seeing them fall down, sell off, and they're selling off aggressively. As they're falling, we expect them to fall back into the low support, and that would mean interest rates should go back above 4%. And if we're talking about the debt ceiling deal, expectations now are saying 700 billion to 1.2, maybe 1.3 trillion of new treasuries will be issued almost immediately after the new debt ceiling deal is signed. When that is inked, we expect to see not only the demand decrease, the amount of supply flooding the market, and we're going to see it break through this low. And if we trade based off price patterns, the move from 116 to 110 could duplicate, and we're talking about 6 points lower in bond prices, in this Treasury note prices, that is. So if we see that break down, what would that mean to the 10-year Treasury yield? Back to the Treasury yields, you can see that if we go from that 3.3% to the 4%, 3.2 to 4, and we see it break out, the duplicate, well, 4.1, the duplicate here would likely see us over 5%. In fact, the target I would have is about 5.25%, 5.5% based off the price patterns and the moves up. Keep in mind that the reason why there is growth is because there's free and cheap money, and if they're expensive, keep in mind that the reason why we had all that growth during zero interest rate policy is because there is plenty of money, plenty of supply of money, and it was cheap. If we're seeing rates go up back to 4.1, possibly to 5.2, 5.5, 5.6% higher, we see these massive moves higher in interest rates, that will dry up the borrowing. Not only will it dry up the borrowing, it'll dry up the growth. And not only will it dry up the growth, but remember that new issue, that new tranche of 700 billion to 1.2 trillion in bonds and treasuries will suck the rest of the cash out of the market, because that money is going to be used to pay debt, make payments, not to grow the economy. And so we'll see a drop in liquidity, probably a drop from 5 to 10% of market liquidity if all $1 trillion are put out into the market. Additionally, again, borrowing rates will hit 5.5%. And generally speaking, you can take this Treasury yield, and whatever it's at, currently 3.8, you can add 2% to that, and you can say, yeah, I should be able to borrow on a mortgage for about 5.8% if I have good credit. If I don't have good credit, you probably ought to go up to about another quarter point to a half and call it 6.25, 6.125. And that's the mortgage rates that we're seeing today. If we get up to 5.5 or higher, we could be seeing 7.5% interest rates, 5.5% mortgage rates. If we were to make a similar correlated view and a similar price targeted view, let's just take a measurement here and go from the low support area to the short-term resistance. That means the rate should go up to 4.5%, well above our multi-year high. Now, if we were to go back and anchor from this low to the most recent high, treat this like a bull flag, then just that move would see us going up to 50, which is 5%. And the flag portion of this, it's not quite a flag pattern. I totally see that. But that would put us to 5.3 or 5.4%. Now, again, I know it's not a traditional bull flag, but the idea is the price patterns have a tendency to repeat. And we could be 5.5% versus our current of 3.7%. Once again, go back and match and compare that to the S&P. If we're to look at the S&P and focus on just the return to the previous lows, we're talking a move from 4,200 down to 3,850. We're currently at 4,161. But if we break out and duplicate, this is a very sideways pattern. And if we break out from here and fall, and we do the same move down, we could be looking at a move that is going to push us all to about 35.13. That's about a 15% drop from our current price. That duplicate of this price action would push us down to 35.13. That's about a 15% drop from our current price. 15% is not that scary, but it certainly pushes us into a bear market. It pushes into bearish territory, and then it could continue from there. You might look at the data that came out today and say, well, GDP is rising. That's a good sign. We have growth. We're seeing expansion. Is the Fed ignoring that? Well, short answer is no, they're not ignoring it. They're seeing that. Remember that 1.3% inflation data is 1.3% inflation adjusted based off of prices rising. So 1.3% GDP is accounting for prices moving up. If we're still dealing with double-digit inflation, then we are nowhere close to seeing inflation be in check, and therefore, I don't think they're ignoring the data. GDP rising only gives them the justification to continue to raise rates because inflation is still high. And in case you aren't familiar, preliminary GDP is actually not the earliest. Advanced GDP is the earliest. So advanced GDP is the earliest indication of inflation. Preliminary GDP is, hey, now we've collected more data and it's showing accurate. And then we have a final, and the final is saying now we're past it. So advanced is predictive, preliminary is semi-predictive, and we're still showing growth, but that growth is a little bit slower. And again, GDP is measured by taking the total amount of goods and services you buy or pay for, and then you multiply them by their prices. You get that, you sum up a total and said, this is what our gross domestic product is. So GDP is always going to be climbing at the rate of inflation or more because we're raising prices as inflation goes higher, whether we're talking about products or services. The only time that's not the case is if we are in a hyperinflation situation where we have a decrease or stagflation, so we do not have the growth even close to the inflation rate. And we're already negative now. So let's run some numbers. Let me show you a chart on the economic data. And we will do that right here. This is on the economic data on the thinkorswim platform. Now, one of the things we got to look at is we got to look at the idea that if we're looking at inflation data, then we would go and look at consumer price index and PCE. Tomorrow PCE will be released, and PCE is the number that the Fed considers the most important. If I click on that PCE, and you'll see we have all this data here, we're going to go to consumer price index for all consumers, and we're going to see this is inflation. This is the inflation rate. So all the way back from a measurement down in the 20s, from the 1950s, you can see the acceleration through here. This is the steepest acceleration we've ever had. One of the tools I'd love to do is do the comparison of both money supply and we'll do it here, is looking at the percent change from a year ago. When we look at the percent change from a year ago, we can still see we're at 5%. This is what we're really kind of tracking. But if we look at the percent change overall, we're still seeing a growth of about 0.2%. And again, 5% here, where we peaked about 9. It is actually a little bit higher than what it's showing here because this is month to month rather than tracking it day by day. But this is a pullback, but if we're looking at 5% here and 1.3%, 5% inflation, is the Fed ignoring this data? GDP is at 1.3. So what we're really seeing is that the economy is growing at 1.3%, but inflation is at 5%, which leaves us with a 3.7 market contraction. Is the Fed ignoring that? Now, one other indicator I want to look at before we go back to the charts is this data right through here. We can look at the economic data and say, show me what our labor costs are, employment costs. What's it cost to employ all the people? And a lot of times they say, look, the inflation is going up and the wages are falling short. And so we think that the services side is low and we're not seeing the increased income. Well, according to Fred, and according to the data, if we go to the employment cost index, total compensation, this is the compensation. Now, again, this doesn't mean a whole lot because it's just an upward sloping line. I don't know how it compares to actual growth. And if we looked at GDP, we saw 1.3%, and we looked at inflation, we saw about 5%. So we'll do the same thing here. We'll change this from quarterly and say, show me percent change from a year ago. And as you can see, our wages are increasing roughly at the same rate currently, at least our last couple of months, as inflation. So wages are catching up to inflation. That's a good sign because we will have a tendency to continue to spend money. It is a bad sign in that costs are still holding up, and now we're having all the costs hold up at 5.5%. I believe all of this, unless the Fed is going to ignore it, all of this is saying that we're going to pump the market full of bonds, reduce the value of bonds, increase the interest rates overall, and we will also see another rate hike next month. As of today, we have shifted from no rate hike and possible pause to a 70% likelihood of a pause, all the way down to 47% as of today and a 52% chance of another rate hike. So we're just pricing in from 8 to 35 to 52% probability of another rate hike. The market is now pricing in, the traders of the market, the moves in the bond futures are now pricing in better than 50-50 odds that we're going to have a rate hike in June. So we'll see higher yields based off the existing bonds. We'll see higher yields based off the huge deployment of $700 billion to over $1 trillion of new treasuries in the next days and weeks. And then we will see a rate hike on top of that. We are likely to see a 5.5% interest rate on the 10-year treasury, which means the mortgage rate for homes will be 7.5% to 8%. And a 7.5% to 8% move in homes will likely stop the housing market from growing. Coming back full circle, if we see rates go from their current rate up possibly 2%, we will eliminate this growth in equities that we saw in March. We'll reverse this out and likely continue lower and see a 15% drop in equities. The fact that we haven't moved with rates going up is interesting. That 7%, 7.5% as far as the housing or mortgage interest rates should show up in housing. Now we could start with real estate, and real estate is already going to show you that we're already sliding. And kind of following bonds, they broke out earlier, they've dropped down a little bit of a bounce today, but we could be looking for a new annual low, new multi-year low in real estate. Home builders should be able to put in a top, and I prefer ITB over XHB. And just over the last 3-4 days, they have peaked, they've reversed, they've broke through this short-term support of May. And if we're looking back to erase everything that's happened into March, we're looking for a drop to 65. So maybe another 10-point drop just to retest that low. If we duplicate that, what is that? Let's take a current price down to this low, and you'll see that that is about an 11% drop. So if we clear that, we should see another 8 points or a 22% fall. That will take us through the annual lows. And that's just on interest rates that would say 5.5%, and a 5.5% interest rate will usually equate to 2 basis points higher for good loans and higher for bad loans than that. So 7.5 to 8%. The fact that the equity market is rallying, the fact that the Nasdaq is rallying aggressively, and they're one of the top borrowers of money. If these bonds hit the market, if the Fed ignores this and keeps raising rates, and if we see the higher rates already kicking in, the actual market driving interest rates, then that huge increased cost of borrowing will inevitably hit the technology sector. If we were to look at the XLK or XLY or the Nasdaq, we can already see that we're reaching these new highs. But what if these highs off of NVIDIA are erased by the higher interest rates? What if we fall back just to the March lows? The move from today's high, or at least today's current price, down to just the March lows is 18%. If we duplicate the pattern that we had before the breakout, then we'd go 12% twice, which is 24%. So I'm looking at this potentially creating a 18 to 24% drop if those interest rates surpass 5%. Well, that is going to do it for me today. Thank you for watching, and join me again next week.